Welcome to the Breaking Into Finance podcast. My name is Craig Thompson, and this is the open source field guide to help you understand everything you need to know about breaking into finance. Let's dive in. Hey everybody, today we are wrapping up our 3-episode primers comparing the venture capital, private equity, and hedge fund space. Today we are concluding that conversation talking a little bit about hedge funds. As you'll hear me mention in the episode, just disclaimer, the hedge fund industry is the only industry among these three where I haven't personally worked. So I've been a professional private equity investor. I've never been a full-time VC, but I have angel invested in a couple of deals. And then I've also, as an entrepreneur, raised venture funding. So I've definitely been involved in negotiating and closing venture deals just from the entrepreneur's perspective. And from the hedge fund perspective, I'm very familiar with the industry. I've met with partners at hedge funds, heard about their strategy, but that is the one area that I haven't personally done professionally. And I think for a couple of those reasons, you'll hear that this is shorter. Last thing I want to mention is at the end of this episode, we touch on a topic that I think is just truly interesting and fascinating, which is, let's say you're someone who has the opportunity to pursue any of these industries, whether it be investment banking, private equity, venture capital, hedge funds, and let's say you're focused on impact. So you're not just focused on what your personal bottom line and P&L looks like, but you're thinking about the impact you have on society, on other companies, on other people, and you want to understand, like, what does the impact look like in each of these industries? So we're going to spend some time at the end of this episode talking about that. Would encourage you to stick around and give that a listen.
What kind of people do you think would be or would do the best working at a hedge fund or be most drawn to a hedge fund?
Hedge funds are even more quant heavy than private equity. It's also a lot more of what I'll call a gambling mentality, because a lot of what you're doing at a hedge fund is, when you're investing in public companies, you're trying to be smarter than consensus, and you're still buying a minority stake of these businesses. Like, you don't have any control. You don't have any operational control. So you literally, like in private equity, the way that a lot of these firms create value is by buying a company and running it more efficiently than whoever was running it before. So there's like an active value creation there. Whereas with hedge funds, you don't have that lever. So you literally just have to be smarter than everybody else. And it turns out that it is very hard to be smarter than everyone else on a repeated basis, which means that the hedge fund life is really volatile. The average tenure of a particular investment professional at a hedge fund is something like 9 months. It's absurdly low. And a lot of that is that if you're a hot hand, like, it is hard sometimes to figure out how much of your success is due to luck versus skill when you're making some of these investments. And so if you are, very smart and on average making great decisions, but something happens to go against you or something doesn't go your way, you might be an underperformer and you might get fired. It's really fascinating and crazy how big the turnover is in the hedge fund world. The caveat I will say is it's usually pretty easy, if you were in this world, to get fired from one place and get hired at another place 2 weeks later. So, don't feel too bad for these folks, but it is a very volatile world. In full transparency, I probably know less about hedge fund investing than I knew about private equity, because I worked for a private equity fund, or venture because I've raised venture funding as a founder and entrepreneur. I've met with probably order of magnitude 12 to 15 different hedge funds. Like, I've been in their offices, I've heard their strategy, I've heard their pitch. As a business school student, we do these treks, but that is where a lot of my understanding of the space is built on. In terms of money and kind of reward and return, large hedge funds are comparable in size to large private equity funds. So I would think of hedge fund salaries as comparable to private equity salaries, but hedge fund investing can be more liquid right? You're in the public market, so you can buy and sell more easily. So if you have a really good year, you will make a lot more money in that one really good year as a hedge fund investor than you would in private equity. Because in private equity, you might have done a great deal. And it's like, you're a super smart investor, but now you're still not going to sell that company for another 4 years. And you aren't going to make your money based on that one company. You're going to make it based off the overall fund. And so the fund might take another couple of years to fully pay out. And so in private equity and hedge funds, it's comparably large amounts of money. But in private equity, it's kind of coming at a more steady pace versus hedge funds. It's a lot more boom and bust. I want to spend a little bit of time talking about how hedge funds can make money and like what the concept of a hedge fund is, which is really, in theory, the idea that you are taking very concentrated bets on a particular thing that you think will happen, or on a particular thing that you think will happen, and hedging your risk to other things. So one example of a type of investment that a long short hedge fund might make, where long short means that they can take both long positions and short positions, is that they might say, hey, Uber is going to outperform Lyft. And so they won't just buy Uber stock, they will also short Lyft stock. And the goal of that pairing of being long Uber and short Lyft is to still set themselves up to make money if they're correct, even if the whole stock market comes down. And so that's a lot of the theory of hedge funds, is that they want to be indifferent towards whether the S&P 500 is up or down in a particular year. And they want to find specific areas of outperformance.
And then what if they guess a company is going to outperform another company, but then they're incorrect?
Then they lose money.
Okay.
Then the opposite happens, and they have a lot of leverage on both ways, and they blow up. And if you made that idea, then you'd get fired. And that happens a lot. That happens a lot of the time. And so a lot of hedge fund work is drawing quantitative conclusions based on alternative data sources. And so this would be things like using weather pattern predictions to try to estimate, just taking the Uber example, like Uber passenger volume changes based on weather. Like if all of a sudden it rains, prices surge because everybody all of a sudden wants to get an Uber and nobody wants to walk outside, like if you're in New York City. And so if you as a hedge fund knew that this upcoming month was going to be a particularly rainy month in particularly large metro areas, that might be a reason to invest in Uber. And in that case, that might benefit both Uber and Lyft similarly. So what you might do is you might buy Uber, you might buy Lyft, and you might short the S&P 500. Or you might short some automotive index or some other thing that is closely correlated to the performance of Uber and Lyft, but doesn't have that same exposure to weather. And so in the hedge fund world, you hear a lot about alternative data. It's basically like trying to get whatever numerical, quantitative information advantage you can, and then try to create ways to profit off of your incremental knowledge in this one thing while protecting yourself against the natural ebbs and flows of the market. Just to give another example, there is a whole little sub-industry of biotechnology focused hedge fund investing. And in that case, folks at that hedge fund might be a bunch of like MD, PhDs, like physicians who may have done research on a particular area of medicine And they might be looking at 5 public companies that are all have kind of like different approaches to trying to treat something like, cancer or migraines or, or weight management, or there might be like some number of experimental drugs that are kind of in the drug pipeline. And you as an MD, PhD might have more knowledge than the market on where the science is likely to lead to better outcomes. And so in that case, you might pick a winner from that basket of 4 or 5, and you might short the other 4.
Is that common to see like MD, PhDs working at these hedge fund companies in like the biotech?
It is in healthcare investing, yes.
Mm-hmm.
And that you'll see in a lot of hedge fund investing is a combination of subject matter experts and heavy quantitative experts. So you won't see a lot of anthropology professors that aren't very quantitative, focused on, whatever anthropologic related startups or, public companies might be out there. So a lot of these hedge funds tend to gravitate towards hiring folks with advanced degrees in STEM fields, because they both have subject matter expertise in kind of cutting edge technology areas. And they also might be, the people running a lot of the algorithms that guide some of their decision making based on some of this alternative data. So think of the hedge fund world as finding this alternative data interacted with superior data analytics skills. And as a result, there is some world where it's hard to know whether in the short term you are skilled or just lucky. And so that's where you get a lot of turnover in the industry. So now that we've talked about all of those, I think my 2 cents are private equity tends to be the right place to be for a lot of people if you have the quantitative chops and the Excel skills to go pursue it. If you really are not a quantitative person, it's possible that none of these fields are right for you, but venture, if you are extroverted and, willing to put yourself out there and kind of make these relationships and build these relationships, might be a little bit more attractive to you. And then hedge funds, if you are a very heavy quantitative person, like you're thinking about for your first job, working on Wall Street, or maybe you've been accepted into a top 10, physics PhD program, that is kind of the type of arena where you're more likely to attract some interest from hedge funds.
I just have a quick last question about hedge funds. Since the turnover is so quick, like I guess you can just lose your job pretty quickly when you're working at a hedge fund. Do you find that there's a lot of like people transferring from company to company since?
Yeah. It happens all the time. It's this weird merry-go-round and carousel. And I guess now that we've kind of talked about kind of like the classic hedge fund context, which is public markets investing, long, short equity hedge funds, the concept of being a hedge fund is basically, like we talked about, alternative data plus superior data analysis leads to finding areas of profit anywhere in the world. We talked about hedge funds that invest in biotechnology companies, that invest in, Uber and Lyft. There are hedge funds that invest in commodities. Like there are hedge funds that might be long gold and short copper. There are hedge funds that invest in all sorts of imaginable things. I'm not aware of any specific hedge fund that does sports betting. I'm sure that exists. I'm sure that somebody, will make a bet that is long, some team or some player and short some other thing because they found a correlation between those two outcomes that is not adequately priced in the market. So it really is kind of like a quantitative driven strategy. The other big, I think, broad drawback with hedge funds is you're not really creating positive outcomes for people. Finance is certainly not a beacon of social impact opportunities, but insofar as you are someone who cares about the outcomes of the work you're doing and the externalities of the work you do, in investment banking, you're working with clients and you're helping them pursue their goals. And it's an open question whether their goals are, good for the, economy, environment, society or not, but you're helping somebody. And in private equity, similarly, you're helping companies run more smoothly. In venture, you're funding entrepreneurs that are building, life-changing or society-changing innovations. Hedge funds are the one pocket of this where it's zero sum. Like you're betting against somebody else. And when you win, somebody else is losing. And there's no positive sum outcome where you're making a better thing, other than the loose argument that you're making markets more efficient. Which is to say, the only way that as a hedge fund you can argue that you're providing some sort of social good is you are one of many hedge funds that are trading lots of things. And because they all think they're smarter than one another, they help, Apple's stock price get closer to the true stock price. So if you or I just want to buy Apple stock without thinking about it, it's a lot more likely that we're buying that stock at a fair price. But also maybe that happens anyway with all of the other investors in the world. We didn't need hedge funds to do that. And so that is why I think I want to draw the very specific distinction that the impact of hedge funds is very different than the impact of venture and private equity and banking. It is very much a zero-sum world where their profits mean somebody else is losing. Whereas in all of the other facets, it's positive sum where they're producing something that somebody else wants, or they're helping companies produce something in a more efficient way. All right.
Wow. I feel like, yeah, I don't know. Just the way, like you said, the other three are I guess, can have benefits for all, but then hedge fund is someone's always going to be losing. My cousin just went into got into private equity, and she was telling me and a couple other my cousins about it. And one of my cousins was really against it. He was they just take companies and ruin them. So that's interesting that now as time has gone on, that's I guess less common.
Yeah, I think the negative reaction is historically extremely accurate, but in modern day private equity is a lot less true than it used to be.
Yeah.
And some of that, is for all the reasons we discussed. It's not that these are altruistic, private equity guys who are we need to be better for people. They're still profit seeking, but it turned out that what was more social and governance friendly was also more profitable.
Mm-hmm.
That's one component, certainly. But another thing is that these private equity funds have gotten so big that if you think about who the investors are that are giving them money to go out and buy these companies, it's a lot of endowments. It's a lot of pension funds.
Mm-hmm.
And it's a lot of organizations that are mission focused and would just not have ever invested in 80s style private equity.
Mm-hmm.
These are California, teachers, pension fund.
Yeah.
Is one of the larger players, or New York State firefighters. It's a lot of these funds that at some level would say no to, very poor governance investors that are ruining companies.
Mm-hmm.
And will also at the margin give a little bit more money to fund, kind of more ESG friendly opportunities. And one of that is actually when I was at KKR, they raised an impact fund. They didn't have an impact fund before. They raised a $1 billion impact fund. And the way that they went about that decision process was a New York State retirement fund basically went to KKR and said, hey, you don't have an impact fund. One, can you think about what that might look like? And two, we'll contribute $500 million towards it if you end up doing one.
Oh, wow. So I'm guessing they ended up doing one.
Yeah. And it was
Yeah.
like $1 billion fund. Like it wasn't, which is $1 billion is a lot of money, but like their flagship fund is like a $15 billion fund. But like going out to all of these other investors globally to try to find like, what's the right amount of money to raise for this fund. Just this one anchor investor was half the fund. And so it likely would not have existed without that initial collaboration of them saying, hey, what if you raise this? And that fund is actually super interesting. I worked on one deal that fund invested in my time there. And what I found fascinating about their strategy is for them, the social, environmental, governance impact was the value creation. So like one type of investment that they would do is go find some very environmentally unfriendly company, or like someone that was like getting sanctioned for like spilling chemicals in the river water and that nobody wanted to buy because they were a mess. And then they would buy them for very cheap. Like basically like the previous owners would still make some money, but they would make a lot less because of all of the things they'd done wrong. KKR would then bring in basically like an environmental cleanup team to improve the operations, to declare all of the problems, to basically like have a big mea culpa for like, this company's been run incorrectly. We're going to improve it. They actually improve it and get its operations to a much more environmentally friendly position, to the extent where then they can sell it to someone who's like, oh, this actually isn't a problem anymore. And the value creation there is on the exit multiple, where there's, they might have bought it for 4 times EBITDA because there are all these problems. And then they sell it for 15 times EBITDA, even if their profits are declining, because they're like, hiring all of these environmental experts, they're putting all these new protocols in place. Like they don't mind hurting the profitability of the business if it means turning it into a more environmentally friendly, socially acceptable business that someone else will pay a higher premium for. And anyway, I just thought that was a super cool part of the strategy that they've done. And it's a little bit different from public markets ESG investing, which is a lot more passive. And it's a lot less clear what the direct impact of like you buying your shares means for the performance of the company. So that is to say, there is a segment of private equity that would vehemently argue that they're like a huge social good. I'm a little bit of a skeptic about that, because I think it is true. It is 100% true in very small pockets. But predominantly the narrative that's really taken place is that private equity happens to be a lot more ESG friendly, but that's only because they're profit seekers, where 1, that's kind of like the way to make money in this market, and 2, that's what their LPs, their investors, are demanding.
That does it for today's episode. Thank you so much for listening, and remember to check out our website, breakingintofinancepodcast.com, where you can submit questions, join our Substack to stay up to date on new content releases, and much, much more. We'll see you next time.